Okay, so welcome to the webinar. My name is Mark Berman and I'm from Foster de Novo Private Clients, and I'm going to show you what you can do to preserve and protect your estate for future generations. Now, I'm a certified financial planner and I'm a member of the Society of Trusts and Estate Practitioners. So I'm going to run through a variety of topics today, and you're going to find this really useful. You'll be able to ask questions as you go along using the Q&A feature that's somewhere on the screen. And I'll also be sending a link to an online survey after the webinar. It's a really brief one. I'd be grateful if you could complete that. And we're always looking to improve these webinars, and feedback's really important. Okay, so for the next 30 or so minutes, I'm going to take you through a variety of things. So we're going to understand how estate planning can work so that the right people get the right money at the right time. We're going to run through 7 ways that you can reduce inheritance tax and preserve family wealth, hopefully in pretty plain English without getting too technical. I'm also going to walk through the optimization of estate planning through cash flow modelling, and I'm going to show you how the use of trusts can control family wealth for future generations. So what I find when I'm speaking to clients about estate planning is it's really a question of 2 things. One is about the tax and the tax position, but the other is about the control side of things and passing money down through the bloodline and retaining money for the family and future generations. So I'll concentrate on both these areas for the webinar. Okay, so the first point on here is understanding how the right people get the right money at the right time. It's a really crucial thing. So some typical estate planning questions that I get. Do I need a will, or should I update if I have one already? So there's obviously 2 parts to that question. Most people need to have a will, but what happens if you die without one? So I'll talk about that a little bit later. But in relation to updating it, there's been lots of changes in legislation from 2007 onwards. And potentially, if you don't have a modern will, that can be a problem. So I'll address that again later on in the webinar. The next 2 bullet points really kind of tie in together. So people ask me, how do I make plans but still have some flexibility in case my circumstances change? And how can I reduce my tax without impacting upon my current lifestyle? So you might need capital now, or you might need income now. The question is, how can you make sure of these things when you don't know if you're going to need the money or not, and if you're looking to pass the money down? And for a lot of people, the big question is, how do I reduce inheritance tax that my children will pay? Now, there might be some people that aren't overly concerned by this, and they might take the view that if HMRC are going to get their share of tax, then that's fine. But I've certainly got other clients who want to pay as little as possible, and I'll show you some ways that you can reduce it. Okay, so the primary thing I find people are really asking is, how do I make sure that my partner, my children, or my grandchildren are looked after when I die? That could be my wife, my husband. How do I make sure that they're taken care of? So I'm going to touch upon care home fees. A regular question I get asked is, will my home have to be sold to pay for them? So it's not as straightforward as you might think, and certainly care home fees are more expensive than a lot of people think. So I'll show you some numbers just a little bit later. What about my parents? So it is possible that they're going to pass money down to you, perhaps. Are they going to pay inheritance tax that they shouldn't be paying? Are they potentially going to pass money down that's going to make your position even worse? So what plans have they got in place? Something to think about when you think about your own planning is obviously that can be really affected by your parents' inheritance tax position. Another question you might have or heard or think, well, trusts are really expensive and complicated, aren't they? And well, they certainly don't have to be. And I'll show you some simple ways and ideas that will make that clearer to you. So what we do find with the whole estate planning piece that I get involved with, it's really a balancing act between, on one hand, having access and control, and on the other hand, trying to reduce your tax liabilities. It's really a question of focusing on what's really important to you, rather than retaining some form of access. So it's making sure that the money passes down to your children with some really tight controls as to how they can use it. And when they can access it, what they use it for, and it's about trying to reduce the taxes of all things. It's really very much a balancing act. So this is a slightly older piece of news now, a couple of years ago, but it's from Sir Alan Sugar, and this really brings home the point. So he gave his son some Amstrad shares and a lot of money to buy a property. And then his son gets married and later divorced, and Sir Alan wanted £5 million back from the former wife. And she blamed him for the split, which is funnily enough, but that was something that ended up going to court. And it's very interesting. So we find that most clients are really keen to mitigate inheritance tax. They want to reduce the amount they pay, and they're really keen to protect and control the wealth that's passed down. And of that, the probably primary thing is they want to protect it, pass it down in what we call an ordinary and orderly manner. So we find that family wealth can be eroded in three ways. So we find there's an inheritance tax. So I'm going to explain to you how you can reduce it. Now, I've heard it described as a voluntary tax, and in some respects this is correct. But for sure, when it comes to IHT planning, the sooner the process starts, the more you can do something to reduce the tax, and that can have a big impact upon the eventual tax paid. For others, we find that a divorce and creditors, so what we know as social impacts, can have a big effect on the amount of money that's passed down. So the divorce rate in the UK is over 42%, and that's 120,000 divorces a year, which is really quite remarkable. So, see how many more we might get. I mean, we're just coming out of lockdown. Let's see how many more we get after that. We may get a few more divorces. But what I'd say is, if you do have children, hold that figure of 42% in your mind. This is a really powerful drain on family wealth. And the other real point is with creditors. Again, in the current environment, there might be a lot of small businesses that have got the bank of mum and dad backing them up. They've perhaps had loans or money passed down to them, and potentially that capital is at risk from creditors if the business fails. So the next point is care home fees. Again, that can have a huge impact on the money that gets passed down, and I'm going to be talking to you about that in just a moment. So a bit of useful information, just to cover a few stats. So HMRC, that said in the last reporting year, so that was the 18-19 year, the inheritance tax in the bill went up to over £5.4 billion. So that's an increase of 3%. And the number of families paying inheritance tax reached an all-time high. So almost 5% of households now will be paying inheritance tax. And quite surprisingly, over half the adults in the UK don't have a will. So legislation was introduced in 2015 and it came into effect in 2017. And it means that wills need updating. And again, I'll cover that in a bit more detail in a moment. So care home fees. So if you've got assets in excess of 23,250, it can mean that potentially you pay for your own care. And fees in the southeast, the average for care home is almost £800 a week, and the average stay is say 2.5 years. That's just over £100,000 in care home fees. Again, with sensible planning, you can mitigate that. So a very simplistic example of how inheritance tax works. And I'm sure you're all aware of this, but it just makes it really clear. And this is just an example with a single person who's just using one allowance, which is called the nil rate band. And that's an amount of money that you can pass down without paying any tax. So it's currently $325,000. So if your estate is worth $325,000 or below, it's very simple. You have no tax to pay. If your estate is worth $425,000, you obviously have £100,000 over and above that threshold. So you pay 40% on that £100,000 and you've got a £40,000 tax bill. If your estate is worth $1 million and you do the maths in the same way, the tax bill is $270,000. And if you start looking at estates worth $5 million or over, you're paying nearly 1.87, almost £2 million in tax. Okay. So what puts people off estate planning? So why don't people do more of it? Well, they're obviously concerned about giving away capital and income that they might need in the future. And again, I'll show you how you can really plan for that properly. They perceive a lack of flexibility. So they don't want to do something and then change their mind a year or 2 or 5 or 10 years down the line. And they might fear that they might be able to look after themselves financially. And there's also a perceived complexity and cost of estate planning, which isn't always the case, and certainly not when we organise it the way we do things. But these are typical things that essentially put people off, and we'll cover those as we go through. So what we're going to do now is cover 7 ways to potentially reduce that tax. So interestingly, there's an inheritance tax review that was due out this autumn. It still is, as far as I'm aware. I haven't heard that it's not. And they were looking at some form of simplification for inheritance tax. Now, I think with the outbreak of COVID and the amount of money the government is actually having to put into the economy to pay for the furloughs and salaries and what have you, I think it's unlikely we'll see the inheritance tax changes coming along anytime soon. And I can only really see the government needing to raise revenue from anywhere they can potentially can. And therefore I see this as an area that they might want to look at. So I think it's important to consider what strategies you should be setting up to counter this. So again, if you're considering doing some inheritance tax planning, I would encourage you to look at that certainly before the autumn. So moving on to the 7th strategy. So one thing that I'll cover is making sure that you've got a modern will. Now, you can do a lot with the will to make sure you're planning that the right people get the right money at the right time. So we'll cover that. And you can also look to reduce the size of the estate. Ultimately, the only way you can pay less tax is to have a taxable estate that is smaller. And you can do that in a couple of ways. You can spend money, and that's certainly one way to reduce the size of your estate. But we'll cover how you do that properly. And you can look at giving your money away. Again, what happens if you want to do that? You can potentially invest in inheritance tax friendly investments. So these are the things that they stay in your name and they allow you to keep control of the capital, but they mean your inheritance tax is lower because they're exempt from the inheritance tax calculation. And also, there are trusts, and we're going to run through, although not in huge detail, but there are trusts that allow you access to both income and capital, and in a way it's a way of kind of having your cake and eating it too. So I'll look at that in just a moment. And the final point is you could actually you buy insurance to cover the tax. So you decide there are things you can't do in the short term, but you know there's an inheritance tax bill that you could be or your family could be facing. And we'll cover off how you can use insurance to do that. And I'm also going to cover in detail when the use of trusts and what we call bloodline protection and how we can really protect that money as we pass it down. So what happens if you die without a will? Now this is called dying intestate, and it's not as straightforward as people think. So firstly, not having a will will mean that you will lose the right to utilise a number of inheritance tax exemptions. So it could lead to an increase in liability for the estate. But also, if you wanted to leave something to somebody outside of your immediate family, they may not receive anything under these intestacy rules. So as an example, an unmarried partners or cohabitees have no automatic right to inherit under these rules, nor do dependents who aren't related. While if you're married with no children, then potentially your wife would receive the estate in full. So if you do have children, the situation is more complicated. So the spouse will receive all the personal belongings, the first 270,000 of the estate, and an absolute interest in the rest. Whilst for the children, the other half will go straight to them, but if that's above, the amount going to your children is above the threshold of 325,000, then potentially that money will pass to them with a tax charge. So if there isn't a will, you can die intestate, but even if there is a will, but there's mistakes or any errors on your will, as simple as having a name spelled wrong or something of that effect, the will be contested. And it's really important you make sure you can actually find it. So if a will's lost, your executives don't know where it is, then you can potentially die without a will, even if you wrote one. So that's something practical to be aware of. But also it's really important you have a modern will. And what do I mean? What is a modern will? If you look at a lot of old wills that were set up, say, before 2007, a lot of them use something called a discretionary will trust. And basically that was a way of trying to pass down the nil rate band of 325,000 on the first death, because it wasn't at that point carried over. So at that point, pre-2007, if you didn't use it, then you potentially lost it. And that legislation changed, of course, in 2007. So a lot of people have these old wills that still have these kinds of trusts in them, and potentially that might not be suitable for some. And there's also the issue of having a trust that only comes into force when the will is actually read. So it will very much depend on the legislation still being in existence at the time that the will is read. So again, it's really important to keep on top of the legislation and to make sure your wishes can be met. So the thing that was introduced in 2015, it came into effect in April 2017, is called the residence nil rate band. Now, everyone has the normal nil rate band with 325, and they can pass that down free of inheritance tax. But what we've seen, interestingly, over the years, particularly in the southeast, there's more and more people being dragged into the inheritance tax trap, if you like, just because the house had gone up in value. And they bought it, say, 30 years ago, it's increased exponentially. And now they're paying inheritance tax. So even though that's the primary asset, they've been pulled into this trap. So the government introduced something called the residence nil rate band. And basically, it's an extra allowance of £175,000 or up to £175,000, which will be added to the existing 325 nil rate band. Now, that will be added when an interest in the family home is left to what they call linear descendants. So what that means are children or grandchildren of the person who passes away. And there's quite a lot of conditions attached to this. So simply, if you don't have children, you can't use it. If you've got a larger estate, which is worth more than 2.6 million, you don't get it at all. And there's a sliding scale down back to 2 million. And also old wills that haven't taken into account this allowance. So when we set up trusts, we can ensure that this allowance can actually be utilised. Again, another reason to update your will and your trusts. So, very topical at the moment, there's a lasting power of attorney. So, lasting power of attorneys came in and they replaced what was previously called an enduring power of attorney. Again, this took place in 2007. So basically there's two types of lasting power of attorney. One is what's called a health and welfare. Again, this is getting pretty topical at the moment with people who've been in hospital, who've been ill, and perhaps not having anyone that can carry out their instructions or do things for them. And the other is a property and financial affairs lasting power of attorney, which is much more flexible than the old enduring powers of attorney, and they're very simple to set up. The key here is they must be registered with the Office of Public Guardian, but very importantly, you must consider these as part of your planning, so you can make sure the people who act on your behalf when you are or if you become incapacitated. Okay, so you can spend the money to reduce your estate. It's certainly one way to overall reduce the value of the estate. You could look to spend it. It's your money, you've accumulated it, so why not spend it and enjoy it? You can obviously spend things on holidays, cars, property, shopping, gifts, and do whatever you want. And certainly that's one way to reduce your tax bill. It could be argued that if you're facing an inheritance tax liability, then for every £1 you spend, you're effectively getting a 40% discount, as the sum that you spend can't be subject to inheritance tax. So there's a good argument to say, while you're fit and healthy, why not spend it and enjoy it? It's no good being the richest man in the cemetery. Sometimes you've got to enjoy these things, so spending is certainly one option. You could, of course, make gifts, so you can make an annual allowance of £3,000 each tax year, and if you haven't used this the year before, it can be carried over. And if your children get married, you can pass down £5,000 as a parent and £2,500 from grandparents. And you're allowed to make extra gifts from normal expenditure as well. So you can pass down money if you can prove that it doesn't affect your normal standard of living. So if you've got excess income that you can pass down, you can do that. And also you can make unlimited gifts of £250. So anything above these numbers is called a potentially exempt transfer. And that means you can pass down bigger sums, but potentially there's still tax to pay. So the amount of tax depends on, really, quite simply, how long you survive. So there's a sliding scale. So if you survive 3 years or more, the amount of tax payable is reduced. And if you survive 7 years or more after the gift, then there'll be no tax payable on that gift. So the key again is timing and the importance of taking action to gift once you've established a full visual on your finances. Okay, so how much can you afford to spend or give away but not leave yourself short? How do you get this visual on your finances? Then you know what you've really got to do is essentially optimizing all your estate planning through what we call cash flow modeling. And what's that mean? Well, how would you know if you could afford to spend it or gift it? You might be sitting there saying, well, you know what, I think I've got enough money. I think I'd like to pass some money down to my children, but I'm not sure if I'm going to need it. You know, what do we do about that? It's a really important question. How do I know how much headroom I have available? So we use our cash flow, something we call cash flow modeling. And we create a financial plan to oversee your long-term income and expenditure before and after retirement, so that you can really get a picture for exactly where you are. And it makes sure that you don't run out of money, because you've got to make sure you've got enough money yourself to be able to take you through retirement and do all those things that you're planning to do. And that potentially that tells you then how much wealth you can give during your lifetime. So it looks something like this. So this is just a couple of examples. This is what we call a cash flow screen, and this is what we put together for clients. So just looking at this, so that the black line that we have here, this black line here, is your expenses. Now we can see from these different colours where the expenses are being met from. So in the early years, you might be working towards these blue bars. So these dark blue bars are employment income. So we see with this particular client, he's working full-time for a couple of years. Then he goes part-time and receives a lower level of income from employment. But what we've got here is we've got some state pensions kicking in at this point here. We've also got his standard pension coming in here, and he's also using some savings and investments. And we can see how this changes as time goes on through the plan. Now, you might also be receiving inheritances that might also come into this plan as well. And hopefully you're in a position where you haven't got a shortfall, and you can look all the way through your expected life expectancy and see that you can cover all of your outgoings forever without too much of a problem. And where there's some headroom, you can use that for your inheritance tax planning. But what we're really interested in when we're looking at estate planning is what we call the residual position. So here, looking at your overall assets, so the example here, the grey bars, they are your property. And then you've got things here like your pensions in brown and your savings investments. And what you're looking to see here is ultimately, if you've got your plan, how much extra money you've got that realistically you won't ever need. And there may be a number when you do your planning that you can say quite comfortably, I'm never going to need that £100,000 or £500,000 or £1 million. It's definitely something I can pass down. I'll never need it. But without doing that cash flow modelling, it can be very hard potentially to make those gifts during your lifetime. So once you have your cash flow forecast, you can then have the confidence to make those important decisions with your money. Now, what about some tax efficient investments? Now, if you're not sure that you want to give the money away, you're not sure you want to spend it, or certainly you don't want to spend more than you're spending now, there's another way you can reduce the size of your taxable estate and still keep access to the money. So you can use something called business property relief, business relief, which basically exists in a couple of different forms. You can use it for plans that have been designed to utilise that relief by using bespoke structures that are set up. So you could use other investments, which is the alternative investment market, the AIM market. You can invest in agricultural land, and there are a variety of different assets that use business relief in order to make the actual investment itself exempt and outside of the inheritance tax calculation. So basically, once you've held these particular investments for 2 years, then they're outside of the estate for the calculation purposes. So they're still yours, they're still in your name, you can do what you want with them, but you're doing the calculation. When you calculate the value of the estate, they won't be included. Now, in fairness, some of them are riskier than others, but they're definitely an option that you can consider if you want to look at ways to keep money in your name and reduce the value of the estate at the same time. Okay, so let's cover the use of trusts. So there are different types of trusts that, when established, can allow access to the capital and the income, or in fact both. So we have what we call just straightforward trusts. So you effectively, money is going in to the trust from yourself, and they pass down directly to the beneficiaries. Nothing can come back to you. It's all for the benefit of someone else, for example, children. And this would be what we call an absolute trust. Then there's some trusts out there that allow the capital to pass down to the beneficiaries, but give you the right to retain an income. Now, I'm not going to get into a huge amount of detail. I could do a whole other webinar just on the different types of trust, but that's another form of trust that is available. There's also a form of trust that passes any growth on the money outside of the estate and to your beneficiaries, and they can also receive the income, but it allows you to keep control of the capital. So again, I could spend ages going through all the different variety of different types of trusts and what have you, but these are just examples that you can use a trust, different structures to pass assets down. Really importantly, have an element of income and capital and control also for yourself, which again is very much a cake and eat it scenario. So what about, you're looking at all these things, you say, okay, I can't do any of these things right now. I know I've got a liability. It's all tied up in property. I'm not going to spend it. You may say, I don't want to downsize. I can't do any of these other investments. What can I do about my inheritance tax bill? Now, HMRC requires the inheritance tax to be paid within 6 months of the second death, and that can potentially mean having to sell things like property very quickly. So you wouldn't want to be trying to sell a home quickly, in the current climate. You might be selling it at well below market value, but it also may mean that the children actually have to sell the very assets that you're trying to pass down to them. For example, a holiday home, somewhere that you want your children to enjoy. And they would potentially have to sell those assets to pay the tax bill. So one thing that we can do is set up a special type of insurance policy that will pay the inheritance tax liability for you. So this policy will pay out on the second death. So what that means is it's relatively cheap because it's on a second death basis. We can match that either to what we think or what we calculated the inheritance tax liability will be. And it's quite easy and flexible to do these things. We can alter the amount of cover, so we can make sure it goes up each year. We could adjust it so it's in line with inflation. Now, interestingly, I mentioned potentially exempt transfers before. So you'll remember that if you make a gift between 3 and 7 years, there will be a liability to inheritance tax. Now, interestingly, you can take out a policy that will cover the inheritance tax liability and mirror the liability on a sliding scale. So the policy will meet the liability whenever death occurs. And a lot of our clients do back up these potentially exempt gifts with this type of cover. The great thing when you're doing nothing, that's effectively irreversible. So you're not stuck. You can you set this up. If you're not happy, you can no longer pay the premiums. So you're effectively saying, look, the important note is once you stop paying premiums, the cover will stop. But you're saying, I've got an estate, I've got a tax liability, and I'm going to fund it a different way so that my children can keep all of the assets. And we'll deal with the tax from this policy. The policy pays the tax instead of having to do effectively a fire sale, as we call it, on the assets. And that's great because you haven't made any plans that you have to change or revisit. So what you could do is you could set up a policy for, say, a 10-year period, and that would take care of the inheritance tax for 10 years, and then you can revisit it when you're further into retirement and when your finances become perhaps slightly more settled. Okay. So the next part I'm going to talk about now is how we can use a trust to control family wealth. So I've covered some of the reducing tax, but the primary issue is about controlling and protecting the family wealth bloodline. So I'm going to talk now about how to ring fence those assets for the future generations. And if that money's passed through a protective mechanism to the children, the family's not going to be able to, they won't have to keep paying inheritance tax on the same money over and over again as it passes through the generations. And we can make sure that it only stays in the bloodline. So it's only for your children or your grandchildren or their children, and it's very important. It can't go outside, and I'll show you how that works. And we can also make sure that we ring fence the money from care home fees as well. The other point is, without financial planning and using trusts and putting measures in place, when we pass money from generation to generation, particularly if your estate is a reasonable size, without any planning, you can end up with less than 22% of what you started with just within 3 generations, just by paying that tax as you go along. That's without setting up these measures. And that's an incredible amount of money, and that's how much wealth will seep out of the bloodline without measures being taken. So a little bit about trusts and how they work. And, we think trusts are really just for the normal person. They've been used since medieval times, going back to the period of the Crusades, for people looking after assets for those who are going out on the Crusades. And we think the need is as great as ever today as it was in history. Trusts aren't just for the rich. Okay, they can benefit most families. And you don't have to be talking about estates worth millions and millions of pounds to pass money down. So particularly here in the southeast, you might be passing down a house worth £500,000 to your children. They're getting sizable amounts of wealth between them, and you might want some controls or some ring fencing around those sums. And if you look at the house prices over the years, this is set to compound the issue, in my view. So it's not just for large estates. I covered wills previously. A will need to go through probate. Trusts don't, so we don't have the delays involved there. Also, wills can be contested, as we've discussed, and a trust can't. They can potentially last up to 125 years, and they're only really going to reach the end of their life if they go past the 125-year period, or if the trustees decide to wind them up for the benefit of the beneficiaries, or if there aren't any assets left inside them. But other than that, they're really, really straightforward vehicles. So they don't have to be complicated. In the simplest form, they're really just composed of 3 parts. You have the people who are called settlers, and they're just the people that put the money into the trust. The husband and wife, or just the husband or just the wife who's putting money in. They're giving assets, and they can do that during their lifetime, or they can do it on death, or they can do a combination of both. Then we have the trustees. Now, they're really important. They effectively hold the assets on behalf of the beneficiaries, and typically they're working to what's called a letter of wishes from the settlor, which is a guidance that really spells out what the settlor wants the trustees to do for them, how they want to look after the money, and also they will be policing when it passes to the beneficiaries. And we're really keen when it comes to trusts. We describe them as family controlled trusts. So we really want the families involved with those. We don't normally recommend that you use corporate trustees. It can be really expensive. It can be really time consuming. It's far better to get family members involved as trustees, or people that you trust and want involved in your affairs. And I think that's really, really important. And the third person is simply the beneficiaries. So frequently they are discretionary. So you want to make sure that you give the trustees the options to pass to the right people. So you nominate who they are, but you give them the flexibility to potentially change the beneficiaries as required on the settlor's wishes. So they're not complicated, they're quite simple structures, and they're made up of these 3 parts. Okay, so now I'm going to go through another possible scenario. Let's say we've got a husband and wife here. So the husband has got £600,000 in pensions and 4 times death in service salary, which is pretty typical scenario. And something happens to him. and the wife receives £920,000. But let's say, for an example, at some point in the future, she has to go into a care home. And she's there for 3-4 years potentially. The care home fees are, say, 156,000, let's say in this example. So that 920 is down to just over 750. And if she dies, she wants to pass the money to the children. But the HMRC are going to want that tax. So now they've already used their inheritance tax band somewhere else. So 40% of that 764 is going to be payable. And there's inheritance tax because this money is sitting inside her estate. So HMRC are going to want over £300,000 here. So what she's going to do, she's going to pass the children, and she's got 3 kids. So in this example, they're going to get, say, £150,000 each, but we've already covered the divorce rate in the UK. It's nearly 1 in 2. If we assume that 2 of those children get divorced, then another £150,000 walks out of the estate. So from that 920, all of those things potentially happen. The kids are left with just over 300,000 between them. So what's the solution for them? Well, it's something that we call an asset preservation trust. And what you do here, you simply have those assets on death, they get diverted to the asset preservation trust. And what that means is that money can potentially be distributed to the spouse and the children in the future. So it won't be subject to inheritance tax now. Creditors can't get to it. The local authority can't. And neither can a new spouse, for example, her new partner on that previous example. Okay, and in the previous example, we had a pension that was outside the estate, and if the spouse remarries, well, that new partner of that spouse now has a right to that pension and not the children from the first marriage. So this preservation trust makes sure that these things can't lead to an attack on the money that's been paid in. So the only beneficiaries will be the spouse and the children. So it's a very simple and effective mechanism. So just demonstrating here that it just stays within the family unit. Okay, so I wanted to give you another example. It's a real life client that we've recently taken on. So client age 55 with £1 million in his pension, and he recently remarried, and he wanted the money to go to his new wife and not the old wife. He's spoken with a previous advisor about an expression of wishes, and also they spoke about an asset preservation trust, but he hadn't got around to doing it. Now, he dies suddenly, and interestingly, his previous wife puts in a claim for the money because the pension company just had listed as a beneficiary the wife, and it didn't say which wife. So the ex-wife put in a claim, and nearly £250,000 spent on legal fees fighting the case between the two wives. The lawyers decided on a 75-25 split in favour of the new wife. So it still means that 25% went to the old wife, but it could have been avoided by setting up an asset preservation trust and a well-worded expression of wishes. And that's an actual live example of something with a client that I've recently taken on. So what about the rest of the estate? So if the intention is to pass money down from a husband and wife to the children, why wouldn't they include the rest of the estate in it as well? Well, I'm not looking at passing things down whilst you're still alive at this point, but what we do is make sure you've got in place that if something happens to one party, then the assets pass to the spouse. They will pass either absolutely or with what we call a life interest. So what we mean by a life interest, so I'll take the example of a house, and this is one way to deal with the care home fees. You might decide that half the house passes down to the children, and on death, the other half passes down to the spouse in what's called a life interest. So that means while she's still alive, she can live there, but when she dies, it passes down to the children. And this is really useful for care fee home planning. Okay, so on the second death, money would pass down to what we call this beneficiary protection trust. And this is really how you ring fence assets for the children. And you make sure that the money can pass down to them, but also potentially ring fence them from their spouses. So if they get married and divorced, that money isn't passing down to the spouses and it's not passing outside of the bloodline. So it's important to get the right advice in terms of how the money is distributed from those trusts. So it could be distributed via income, it could be lump sum capital, it could be done in the form of loans, there could be options, all sorts of different options as to how the assets can be distributed. But again, it's a way of sheltering those assets and passing them down with some really strict controls as how the children can use that money. So if they're under 18, it could be earmarked for education, and what they use it for could be identified, whether that be a property purchase or uni fees or whatever that might be. The husband and wife make those wishes known on the expression of wishes document that we talked about earlier, and then the trustees have to follow that. So just staying with education, another idea for the use of trusts. So something we've recently done for clients who are grandparents and they're looking to pay school fees for their grandchild, rather than give money to their own son or daughter to pay the grandchild's fees or paying the school directly. So you can actually put money into an educational trust, and then the child takes money out of that trust by way of a loan for the grandchild's school fees and pays the school. But what it actually does is create a debt on the estate for the child from the loans it's taken from the trust. So we put one extra step in here to do some extra planning for the actual children, but it's actually achieving the same objective with money being passed down for the school fees. So that's a summary. Hopefully what we've been through I've gone through quite quickly, but really just to understand the basics of estate planning. And you can be aware of how you can get the right people, the right money at the right time. You know, making sure you've got an updated will set up, you've got trust structures set up, and you can control how the money gets passed down. We've talked about 7 ways to protect and preserve your wealth in plain English. You can make different trusts that allow you to keep access to your capital when you need it. And we've talked about the importance of cash flow modelling. That's potentially make sure that you can make those gifts. It's really important, a key thing that if you haven't done with us or had your advisor, that you should really look at getting a cash flow model done. It's a great starting point. So we've spent quite a lot of time there. We've also talked about how we can use trusts to control family wealth, and also the importance of taking action now to take advantage of time-based planning and really just get that 7-year clock running. So although a lot of this is about inheritance tax, you can see that a lot of it's about control, about ring fencing those assets for the kids, making sure that creditors are the family members if they get divorced, and local authorities can't touch that money, and that's really key. So next steps, where do we go from here? Well, you'll receive in your inbox an online feedback form. Just one page, take a couple of minutes to do that, just give me some feedback. If you would like any more information, you can contact me at this email address. And I can also refer you to a website with other useful information regarding general financial planning. There should be a pop-up somewhere on the screen for a link if you want to make a note of those. And as with any financial presentation, it's important to note that the information discussed isn't personalised advice. If you do require advice that's specific to your circumstances, then you should obtain tailored advice based on your personal situation. So I'll just return to the contact page as I wrap up, and I hope you've got something out of the webinar. Thank you all for coming, spending time watching it, And that's where I'll leave it for now. Thank you very much.